Ken Boy with Accounting Accidentally. This video is called Grocery Store Prices and Mutual Fund Costs. Higher grocery prices. So this is all over the media. It's particularly important now that we're approaching the fall of 2024 and we're in election season. This is all over the news. So according to Yahoo Finance, during the last election, November 3rd, 2020, food inflation was running at about 3.9% annually. Fast forward to March 24th, latest data shows that food prices have risen over 25% in the last 4 years, 3.5 years. To put that in perspective, a basket of groceries costing $100 in November 2020 costs you almost $126 today, $26 more for the exact same basket of food items. So this is all over the media, higher grocery prices. Investors face a similar issue. Just as higher grocery prices eat into your personal budget and your available dollars, the cost you pay for mutual funds, particularly over decades, can really eat in and reduce your rate of return. So there are three possible costs for your mutual fund, and you can think of it as purchase costs when you buy, annual costs that you pay each year, and these are the ones that can really add up the longer you own the investment, and liquidation or selling costs at the end. So I'm going to use as an example Washington Mutual, a mutual fund that's been around for decades. When I was in the brokerage business 40 years ago, we were selling this fund. It's a great fund, blue chip stocks, large company stocks. So that's what we'll use. So here are the annual fees currently for Washington Mutual. A management fee, other expenses, and a 12B1 fee, which goes to compensate the investment advisor for ongoing help and consulting to the client. So you add it all up and it's around 56%, I believe. It says according to the most recent prospectus. Now, that 50.56% is the expense ratio, and you'll see that you compare that expense ratio with other expense ratios for similar funds. And you can see that here's the symbol, like a stock symbol for Washington Mutual, 0.56 is much lower than the industry average for similar funds, 1.07. And the definition of an expense ratio, it's the fund's operating expenses, which we saw on the prior slide, divided by net assets, according to Investopedia. The other expense you may have is the sales charge. Now, this has changed dramatically over the past decades. Much, much lower sales charges than we used to have. So you'll see the maximum sales as a percentage is the initial sales fee generally paid to brokers as a commission. That's at the beginning when you purchase. Deferred charges are paid when you redeem shares. One thing that's fairly new in the industry over the last 20 years is you can pay the commission at the end, and the longer you hold the fund, the lower the commission is. But for this example, if you pay at the front end, at the beginning when you purchase, it's 5.75%. You may see the deferred plan is it gets lower and lower and lower the longer you hold the fund, and after 7 years, you may not pay a fee at all. It encourages investors to hold the fund longer. So we have annual expenses and a sales charge that may be paid at the beginning and a sales charge that may be paid at the end. So an important thing to do as an investor is take a very close look at that annual expense or annual fee on your mutual fund. The longer you own it, the bigger impact it has. Compare your funds, annual expenses and fees to other competitors for similar funds, and talk to your broker to see if the expense you're paying is reasonable.